We are taking up today liability insurance. So, liability is one of the most important verticals of general insurance. Like you have seen engineering insurance, fire insurance, number of policies under motor insurance. Similarly, liability is one of the classes or one of the class where number of policies are included. Question is, what is this liability insurance? In fact, liability means the responsibility. The responsibility one person has towards another in the society. What kind of responsibility? If I say you are responsible to me, I am responsible to you, what for? You should not cause any property damage or body damage to me. You should not cause any nuisance to me. Similarly, my responsibility. So that is the way how this society runs. Because this responsibility comes by virtue of law or statute or act. Then rights demand responsibilities too. If I say you will not hurt me, it is my duty and my responsibility that I should not also hurt you. Third, awareness about rights. If I know my rights, I should also know your rights. This is a common sense. And as this society progresses, litigation increases. This is a different kind of thought. In the increasing society, a progressive society, litigations would be more. Because everybody is conscious about their rights. If anybody is infringing the rights, there is the first remedy that go and sue him. So litigation will increase. So this is the kind of responsibility which is prevailing all over the world similarly. One is not supposed to hurt or cause bodily damage or property damage to the other one. Now when this liability becomes a legal liability, the legal plus responsibility means the legal responsibility to pay for the damages resulted by virtue of any law, act or statute. Now, what are the core ingredients of liability insurance? There has to be a mistake or negligence or an inappropriate action. If a negligence or an inappropriate action or your any mistake is causing any kind of harm to any third person, we are responsible for that. Loss because of the mistake could be there. What kind of loss? Bodily injury, property damage or financial loss. Then a third party claim for that loss within the policy period could be there upon you. You are having the insurance policy or not, that makes no difference. But if you have caused any kind of loss, that is bodily injury, property damage or financial loss to any person, that person has got a legal right to sue you, to file a case against you, to claim the compensation from you. And that is the legal liability. Because this liability arises out of the law. Now this entire liability segment is classified under two categories. One is casualty lines and other is financial lines. Casualty lines means third party, bodily injury and property damage claims. Casualty lines include those policies where the bodily injury and property damages are claims are paid to the third party. Casualty lines include those policies which pay for bodily injury and property damage claims to a third party. These policies could be like public liability industries, public liability non-industrial, commercial general liability, product liability. All these kind of policies are paying for the compensation to a third party against the bodily injury and property damage claims. That is the reason these policies are included under the casualty line insurance policy. Another category is financial lines. The second classification includes those policies which are paying for the financial losses to a third person. Means a third party will claim financial losses, and for that purpose whatever policies are there, they are all included under the financial lines class. So these financial loss payment policies are professional indemnity for doctors, professional indemnity for hospitals, director and officers policy, cybercrime policy. Under these all policies, financial losses are paid to the third person who has suffered the losses. So basically, liability segment is divided under two broad classifications. One is known as the casualty lines, other is known as the financial lines. Under the casualty lines, those policies are included which are paying for the bodily injury and property damage claims to a third party, and under the financial lines, those policies are included which are paying financial losses to the third party. This is a broader classification of liability insurance segment. There are certain more liability policies, but the classification is based on the casualties and financial lines. Casualty lines include bodily injury and property damage. Now, what are the basics of the liability insurance and concepts? See, the concept of liability insurance says any liability policy of any general insurance company having the limit of liability or limit of indemnity or sum insured based on the concept of AOA and AOY. Means under any liability insurance policy, the liability of the insurance company is defined or decided on the basis of AOA and AOY. This is also known as the limit of liability or the limit of indemnity or the sum insured of the insurance company. Now, what is this AOA and AOY? AOA stands for any one accident. AOY stands for any 1 year. Now, AOA is the maximum liability of the insurer for all claims arising out of all accidents during the policy period. AOY, any 1 year. If you have taken one, say suppose, industrial liability insurance policy. Now, during the policy period, there were 3 accidents. Out of that, 6 persons suffered the bodily injury and property damage. So, whatever compensation is payable to all those 6 persons will not exceed the AOY limit. That AOY or any 1 year limit is the maximum liability of the insurance company. There may be 1 accident, there may be 5 accidents, or there may be no accident. But under no circumstances the claim amount will exceed the maximum liability of insurance company, that is AOY. Another aspect is AOA, because the liability is based on the AOA and AOY. Now this AOA we stand for any one accident, means each occurrence per claim limit. each occurrence per claim limit. AOA is the maximum liability of the insurer for all claims arising out of a single accident. So one accident can cause bodily injury and property losses both. But the claim amount will not exceed more than the AOA limit selected by the insured himself. So this AOA and AOY have their prevalent ratios. And these are 4 ratios only, not even 5th. 4 ratios stand for as 1 is equal to 1, 1 is equal to 2, 1 is equal to 3 and 1 is equal to 4. Not more than any one. All these 4s are prevailing. Out of these 4, insured has to select any one. This is the choice of the insured to select any one, and that will be the maximum liability of the insurance company for that policy. Now what is 1 is equal to 1, 1 is equal to 4, 1 is equal to 2, 1 is equal to 3? What is this? These are the ratios which represents amount and not the number of time of accident. Listen again. These are the ratios which represents amounts, not the number of time of accidents. So how this basic of liability insurance and concept is applicable? So when we say AOA and AOY, for example, insured has selected for himself 1 is equal to 2. Means any one accident is 1, any one year limit is 2. Now suppose any one accident limit he has selected 50 lakh rupees for himself. So automatically his any one year limit would be 1 crore. Because the ratio is 1 is equal to 2. Now this is the scenario. Insured has selected 1 is equal to 2, any one accident limit 50 lakh, any 1 year limit 1 crore. Now during the policy period 3 instances happened. 1. Situation 1. 3 claims of INR 30 lakh each. During one policy period, there were 3 claims of 30 lakh rupees each. And the limit selected by insured himself is 1 is equal to 2, that is 50 lakh rupees for any one accident and 1 crore is for any one year. So here the question is 3 claims of 30 lakh rupees each means total liability is 90 lakh rupees. That is within the any 1 year limit. And no claim is exceeding the any one accident limit. Because any one accident limit is 50 lakh, the claim is 30 lakh. That means all these 3 claims are payable, subject to policy deductibles only. Situation 1 is very clear. Situation 2. During one policy period, 4 claims of INR 30 lakh rupees each are there. INR stands for Indian National Rupees. 4 claims of INR 30 lakh rupees were there during the policy period. Now 4 claims means 30 into 4 is equal to 1 crore 20 lakhs. Any 1 year limit is 1 crore. Any one accident limit is of course 50 lakh. So here what will happen? What will happen here? 30 lakh each, 4 claims. Means insurance company will pay 3 lakh full. 3 claims of 30 lakhs for full and final settlement. But for the 4th claim of 30 lakh rupees, the remaining sum insured is only 10 lakh rupees. The insurance company will pay only 10 lakh, not 30 lakh. Because the insurance company will not exceed the maximum limit, and that is 1 crore only. So total sum paid by the insurance company is 1 crore. Subject to policy deductibles. Fourth is payable until AOY exhaust. That's all. Situation 3. There's one claim only on the policy. Only one claim. And that claim was of 75 lakh rupees. Any 1 year limit is 1 crore. But any one accident limit is 50 lakh rupees only. And there is a single claim of 50 lakh rupees. What the insurance company will do? Insurance company will pay one claim only, and that would be of 50 lakh rupees, not of 75 lakh. Because the maximum annual accident limit is only 50 lakh rupees. So that is how the limit of insurance company is decided by the concept of AOA and AOY. These three different situations have made it pretty clear how the insurance company will settle the claim. The claim is payable till the maximum limit of AOA and AOY are exhausted. But under no circumstances the insurance company will exceed the AOA and AOY limit. So the concept is very clear. Now, basic of liability insurance and concept. First, deductible. Deductible means whatever policy excess is defined on the policy, that will be deducted out of the claim. And each claim is subject to policy deductible. Say suppose there is a one claim of 50 lakh on the policy. Policy deductible is 10 lakh rupees. The insurance company will pay 40 lakh rupees. But this claim will be treated as of 50 lakh rupees only. Total payable is only 40 lakh. Second concept is territory. Territory means geographical region. Geographical region within which the claim incident must occur. And normally this geographical region is India. Insurance companies are writing their territory or geographical region as India. It could be worldwide also. It depends. The insurance company can provide either of them as per the requirement. One thing you must know about the liability insurance, that liability insurance is a non-tariff product. There is no tariff for liability insurance. Second thing, the coverage terms, wordings and clauses of liability insurance policies can differ company to company. Third thing, pricing and add-on covers can differ company to company. But the concept of liability insurance remains the same. There may be any number of policies with any number of insurance companies. So here if we are talking about territory, some companies may provide the territory as India, some may provide worldwide, and some may extend it on the extra premium. That depends. Second terminology is jurisdiction. Jurisdiction means geographical region where a claim can be filed in the court. Normally third-party liability claims are settled by the court of law because there is a prevailing act called Public Liability Act 1991. So jurisdiction means geographical region where a claim can be filed in the court. Normally you must have seen on the policies. Even companies are having their brochures and they are writing for all purposes the jurisdiction will be Delhi, Mumbai, like that. So they are specifying the cities. So jurisdiction means geographical region where a claim can be filed in the court of law. Options available for territory and jurisdiction. Insurer, as per the requirement, can provide options. Territory or jurisdiction both could be either for India or for worldwide. Normally, we are not providing worldwide coverage. But one more option is there. Worldwide excluding USA and Canada. We are providing the worldwide coverage but excluding USA and Canada. Means if any claim is filed in the court of law of the USA, we will not consider it because that is excluded from our policy. I give an example to make it more clear. Say suppose one tourist comes to India from USA. A tourist came to India and a claim incident occurred here. Maybe by bodily injury or by property damage. Later when he went back to USA, he filed a claim against the insured in USA court. Means suppose I have caused some bodily injury or property damage to a person who came here from USA, who visited and travelled for say some 1 month and then went back to USA. Now since I caused him bodily injury, he filed a case against me in the USA court. He is also aware that I have an insurance policy, or he may not be aware, that makes no difference. Now how my insurance policy will decide, my insurer will decide whether the case is payable or not. It depends upon the two things. What is the territory and what is the jurisdiction. Now suppose in my third party liability insurance policy, the territory given is India and jurisdiction given is also India. In that case, policy will not pay any claim to the person who has filed a case against me in the USA court. But suppose if my policy provides the worldwide territory and worldwide jurisdiction, in that case, even if he has filed the case in the USA court, my insurance company will pay the claim. Because the jurisdiction and territory are worldwide. In third instance, suppose territory is India, means incident must take place in India. Case can be filed anywhere in the world, that is worldwide. In that case also the claim is payable, because he has filed the case in USA, while the incident occurred in India. So the claim is payable. Fourth situation is, territory is India, but jurisdiction is worldwide excluding US and Canada. That means, despite of being worldwide jurisdiction, the person who has filed a case against me in USA court will get nothing, because my insurance company will not pay. They have already excluded US and Canada. So this is an example which is giving a clear-cut picture when the liability of insurance company would be there in case of territory and jurisdiction. If territory is within India and jurisdiction is also within India, nothing is payable. Both are worldwide, claim is payable. Jurisdiction is worldwide and cases filed beyond India, claim is payable. Cases filed beyond India, but the worldwide exclusion says US and Canada are excluded in that case, except US and Canada, everywhere in the world. If the third person is filing the case against me, then the compensation is payable, except US and Canada, because the worldwide territory is given. Now there are two different kind of periods in liability insurance policies. One is simple policy period. Simple policy period means what? As usual, 12 months period or 1 year period, starting from say 1st January 2024 to 31st December 2024. This is 12 months period or annual period, or that is called policy period. Policy period means period from policy inception date to policy expiry date. But There is another period that is called insurance period. Now, how this insurance period differs from policy period? Insurance period means period from policy inception date of the first policy to policy expiry date of the current policy, provided the coverage is uninterrupted. Means I took the liability insurance in 2021. So my policy stands for 2021, 2022, 2023 and now currently 2024. Uninterrupted, continuously. So my policy period is 1st January 2024 to 31st December 2024. But insurance period is 1st January 2021 to 31st December 2024. Means policy inception date of the first policy. So that continuous 4 years period will be called as insurance period. Then comes the retroactive date. Now, retroactive date means the date at which the insured took the policy for the first time and has been continuously covered. So this is also the beginning date of the insurance period in claims made policy. The date at which the insured took the first policy. That is called retroactive date. But with this retroactive date, there could be an extended reporting period or discovery period. Means in case the cover is discontinued, the insured can report claim arising from acts committed within the policy period within the extended reporting period. Say suppose my policy is from 1st January 2024. In the month of March, that is 1st of March, because of me, some property damage was caused to a third person. He could not check it. He was out of station for, say 8-9 months. But he came on 15th January 2025. And then he filed the case on me. Again I am liable. Kyo? Example, see the example. ABC Limited has been buying policies incepting 1st January 2010, means 2010, for last 3 years without a break, with the extended reporting period of 30 days. With an extended period of 30 days. So his policy expires on 31st December. He does not buy a policy thereafter, but still a claim is reported on January 15, means he is liable because the 30 days is extended period. Since the policy has a 30 days extended reporting period, the claim is payable. So this is how the insurance period and policy periods are shown. This is policy period which is expired. This is again policy renewed and currently running the policy. And this is discovery period of 30 days separately. So this total makes the insurance period. Policy period is here for 1 year only, but that insurance period has become for 2 years, 3 years, 4 years, whatever it is. But out of that, discovery period is there, that is extended period of 30 days. Nothing. Basic of liability insurance and concept on the claim made and reported basis. This policy period, insurance period, retroactive date, extended period, claim made and claim occurrence. They are the important aspects of liability insurance. And this should be clear in your mind. I give you one interesting example. See, this is a claim made policy. Loss occurred during the period of insurance but not during the policy period. So claim being first made during the policy period are covered. Listen now. Loss occurred on May 5, 2009. But it was reported to insurance company on May 10, 2010, after 1 year. Now how the policy started? First policy started January 1, 2009 to 31st December 2009. Continuously renewed January 1, 2010 to 31st December 2010. So this policy has expired. This is the retroactive date. But the claim occurred during this policy only, May 9. This starts from January 1 and on May 5 the claim occurred. It was not reported during this policy period. It was reported in the next policy period, that is renewal, January 1, 2010 to 31st December 2010. So when this claim is reported on May 10, 2010, this claim comes in the policy period and the period of insurance as well. So claim is paid. Because the incident has taken place during the insurance period. Maybe it was reported 1 year later. Policy is continuing. Claim is covered. This is called claim made basis. Another is occurrence basis. Occurrence based policy means loss occurring during the policy period. Claims reported within the policy period or thereafter, any time in future. Say for example, loss occurred on May 1st, 2010 or the claim reported on May 10, 2011. Okay, these are the date of loss. But what is the status of the policy? Policy start date is January 1, 2010. So that January 1, 2010 will expire on December 31st, 2010. Incident took place during this policy period. But claim was not reported during this policy period. Claim reported after expiry of this policy, May 10, 2011. So that is occurrence based and that will be processed as occurrence based claim. But this is also payable because the incident took place during the policy period. Now what are the policies available under the product with SGI? These all policies are available. Say professional indemnity insurance for doctors, professional indemnity policy for hospitals, errors and omissions for medical establishment, professional indemnity insurance for engineers, architects and interior decorators, chartered accountants, financial accountants and management consultants, lawyers, advocates, solicitors and counsels. Then public liability insurance, act only, industrial, non-industrial, product liability insurance, commercial general liability insurance, employers compensation insurance, or employers liability or workman compensation, and then carriers legal liability insurance. Now this F and C written before them or written after them stand for casualty lines or financial lines. These are all professional indemnity policies where the financial losses are paid are known as the financial lines. These are all public liability policies where the compensation is paid for bodily injury and property damage. They are called as casualty lines. Now see different policies, how the liabilities is covered under different policies. And it is payable only when the respective policy is there, otherwise not. Say for example, one company made a defective product. Say suppose MRF tire company. They made the tire, but the alignment of tire was not proper. When the driver was driving the vehicle, he was killed because the vehicle was not running properly. There was a product defect. So this compensation can be claimed under the product liability policy or CGL policy, means commercial general liability. This commercial general liability includes two kinds of policies: public liability and product liability. No other policy will pay the compensation. And then comes the design operations. Say another example: gas slips on wet floor in hotel and break his leg. Gas slips on wet floor in a hotel and break his leg. Now, which policy will pay the compensation for this? Because this happened during the operations. So, this is the liability covered under the public liability and commercial general liability. Third example: building structure collapse. Building structure collapsed because there was a design defect in the construction. Now, whatever loss has happened, which policy will pay it? Professional indemnity for engineers, reconstruction and other financial losses are paid. Because a building structure collapse, that is the loss to the entire building due to design defect. So professional indemnity policy will pay for that. Another example: death of people in surrounding due to leakage of poisonous gas, that is hazardous gas. Which policy will pay this claim? So this is payable under public liability and CGL, means commercial general liability, because CGL includes public and product liability. Rajiv, want to ask something? That is coming. Just wait, that is coming. Okay. So how this policy will decide the liability? This is made clear here. Because certain liabilities are payable under their specific policies only. If a design defect is there, if a product defect is there, if due to operations some bodily injury or property damage is there, so their respective policies will pay only. Because number of policies are there: product policy, public liability policy, CGL policy, professional indemnity policy. So there cannot be that the bodily injury is caused by a doctor and compensation is paid under the public liability. No. This compensation is payable only under the professional indemnity policy. So the respective policies will pay. If the policy is not there, then the person is liable and he will pay out of his own pocket. Simple funding. I give you an interesting example. On the 2nd December 1984, in Bhopal, that is the capital of the Madhya Pradesh, Union Carbide India Limited, that is also known as pesticide plant, there was a leakage of methyl isocyanate gas. And due to that leakage of the gas, over 5 lakh people were exposed. Thousands of people died on the same night. This was the real incident happened in India on 2nd December 1984. That is exactly 40 years ago. Union Carbide India Limited, that was an American company, which was engaged in pesticides, means manufacturing pesticides. There the methyl isocyanate gas leaked and almost 5 lakh people were suffered. That time even the Public Liability Act was not there. Only after this incident the Public Liability Act came into existence in India. This act provides immediate relief to the persons affected by accidents occurring while handling any hazardous substance and for matters connected therewith or incident thereto. This is an act. This is the Public Liability Act with defined wordings making certain hazardous companies mandatory to take the insurance policy. And the compensation amount is also fixed. Now the question is, who needs this PL Act, Public Liability Act policy? All those entities who are dealing in manufacturing, processing, treatment, packaging, storage, transportation of hazardous material. But for all industries, this is not mandatory. Mandatory for hazardous products only. As per Act, Public Liability Act, the limit of liability is defined. Say suppose the limit of liability chosen by the insured is AOA and AOY. The ratio is 1:3. So where AOA minimum has to be equal to the paid up capital and maximum can be INR 5 crore irrespective of paid up capital. So therefore the upper limit for AOA and AOY is 5 crore and 15 crore. All premises will be covered, transportation covered, deductibles are nil, trigger means occurrence but no application for relief shall be entertained unless it is made within 5 years of the occurrence of the accident. Now the question is how the premium is calculated. The premium is based on the turnover, paid up capital and the limit of indemnity selected. Group of substances means risk of occupancy. But what would be the composition of premium? Here comes that important answer. First of all, the risk premium will be there plus ERF fund means Environment Relief Fund amount equal to the risk premium. Then tax. Suppose the premium is 5 lakh rupees. That 5 lakh plus 5 lakh. That 5 lakh will go to Environmental Relief Fund amount. And then tax. This is the provision of the Public Liability Act. And what is the compensation? Compensation limits are pretty old. They are not even revised. As per Act, the death or fatal limit is only 25,000 rupees per person. Court may award the expenses on other acts, but this limit is as it is. Medical expenses is 12,500. Injury is 12,500. Total permanent disability is 25,000. For loss of wages, 1,000 rupees per month. Property damage only 6,000 rupees per month. Or total 6,000, depending on the actual damages. Limits are pretty old. Now, base coverage can be given in other policies like non-industrial, industrial, public liability on different basis. Now here in this policy, liability insurance, I give you certain examples which will clarify you the concept of insurance. Say for example, you must have heard Bhopal tragedy, one example you have seen. Another example is Upahar cinema tragedy. This is also public liability, non-industrial risk example. This is also the actual case study. Because on Friday 13th June 1997 at Upahar Cinema, Green Park, Delhi, during 3 to 6 p.m. screening, Border movie was there in the show, 1997. One of the worst tragedies happened when the 59 people died due to suffocation because there was fire in the theatre. In the cinema hall, the fire was there, stampede was there, Magdalmati. 59 people died during the spot, 103 people were seriously injured. But fortunately, that time the Public Liability Act was there. So that act provided the compensation of 25 crore rupees for the relatives and families of the victims. This is still a breakthrough case in the civil compensation law of India, Upahar cinema tragedy. Another case of Jaipur, 2009, just behind the corporate office of Shri Ram, there was a depot of Indian Oil where the tankers were there, filled tankers of petrol, diesel, like that. On 29th October 2009, there was fire in one tanker, one terminal. And it was like a bomb blast. It was so heavy. That caused the burning of the total tanker. And the flames were so high that they touched the second tanker also. Again there was a blast in second, and then in third, and then in fourth. Continuously all tankers were burned to ashes. Fire continued for 11 days. 11 fatalities were there. That terminal was closed. For 11 days there was the curfew in area. All offices, nearby buildings were damaged. 11 fatalities were there. This risk was also covered under the Public Liability Industrial Risk. That time also Public Liability Act was there. This depot was closed, shifted from this place. One more interesting example of product liability. Say crop damage of farmers due to use of insured product like pesticides. Some harmful pesticides were used which damaged the entire crops. It happens in India. Case was filed against the pesticide manufacturer. A compensation of 72 lakh was paid. This liability was paid under the product liability insurance. Similarly, one more case of product liability insurance. An IT company office is gutted by fire due to defective batteries in UPS. The UPS company manufactured defective UPS. Because of the use of those UPS, a IT company burned totally, gutted by fire. So that IT company filed a case against the UPS manufacturer. That UPS manufacturer has to pay rupees 5.2 crore compensation that time. So these are the liabilities. One recent last case which may be fresh in your memory. Few years back, just before Corona, There was complaint that the Maggie is having lead. This is unsafe to eat. When the case was filed before the court of law, company officials also accepted that certain amount of lead is there, and that is harmful. But because of certain reasons, maybe politics or whatever we say, no harsher penalty was imposed on the company. Some fine was imposed, and thereafter with certain guidelines or directions the product was continued. So Maggi is still there in the market and most sellable product. But that was a defective product. So this is the product liability. There are a number of examples wherein because of the losses, bodily injuries and property damage and financial losses, courts have awarded the compensation of millions of rupees. People have claimed the compensation even due to professional negligence. The right leg to be operated, but the doctor by mistake operated the left leg, and when he was sued before the court of law, he had to pay the compensation. Number of cases are there. So these are the liability insurance policies. Now if you have any questions, you can ask. Any questions? Okay, check your mail IDs. Okay. Mr. Praveen Kumar. Just refresh your mail ID. Okay. Okay. Johnson, you also received?